All right, so welcome back, guys. So this this is the continuation of the first video. So this is the second part. So in this part, we are going to be looking at the Forex codes. Now, this is very, very important. Remember, everything we are doing, like I said, is the basics. So it's going to form the foundation of everything you'll be doing in the Forex market or in the financial market in general. So we need to don't neglect any bit of this, please. Give it your whole heart. Now, the Forex quote simply means a quotation of the base currency to the quote currency, what we call the counter or the payable currency. Take, for instance, if somebody tells you that GBPUSD is trading at 1.28570. So what this simply means that for you to get 1 GPB, you need to bring $1.28570. Now, in each quote, or when you see sorry, I think I jumped. Sorry. So this is where we should be, because I want to make sure that you understand currency pair before we start talking about Forex code. So this is what we did in the last class, in the last video, trying to understand the position of the take profit and stop loss. So here now we look at the base and the quote currency. So two currency are involved in every transaction. So in every transaction, as long as you are trading the financial market, two currency will always be involved. Now, this we call them the currency pairs. Now, when you look at the pair, the first currency, now these pairs, depending on, like if for the currency market, is representing the currency of a particular country. Like GBP is the Great Britain pounds for guys in UK and the rest, while USD is United States dollar, get for guys in US and the rest. So these pairs for the currency market is going to represent what that currency stands for, or the currency of that country. But take, for instance, for the metals like the gold and the rest of them, this is now pairing gold, which is a metal, to United States dollar, and the rule of that. We see come to that. You get to, but whichever format it comes in, right? The first pair is what we call the base. So for GBPUSD, the base is GBP, while the quote is USD. Now, take for instance, maybe for a pair like we have the USD JPY. For a case like this, the base is the USD and the quote is JPY. So in whichever format you are seeing the pair, all right, just know that the first pair or the first currency in the pair is the base, while the second currency in the pair is the quote. That is clear. Now, when it comes to the currency market, we have what we call the major pairs, and we also have what we call the minor pairs, right? So the major pairs are the most traded pairs. So they have the highest trading volume. So they are more liquid. So they're highly liquid. So liquidity simply means the availability of an asset in the market. So when a trader tells you that this asset is liquid, that means the availability is much. So that means if you want to buy it and return it, there is more liquidity, there is a liquid, there is more pool of that asset that can actually allow you to buy any quantity and return any quantity without shaking or affecting the pair. And also, they have what we call stable price movement. So they are less volatile. So when it comes to the currency market, we have 6 major pairs. We have the Euro USD, which is the most traded. We have the GBP USD. We have the AUD USD. We have the USD CAD, and we have the USD CHF. And some brokers as well try to categorize these pairs based on the majors and the minors. Based on the majors and the minors. So let me see if this broker did it here. So I will see come to brokers and show you the brokers I use when I'll be explaining the trading platform and the rest. So I'll show you the brokers I use and the brokers you might want to use. So if you watch for this broker, we have the major pairs. So inside the major pairs, you see that it contains only these pairs. We also have the minor pairs. So we have the minor pairs. So minor pairs, will I say they are the second class. So major pairs are like the first class citizens. Minor pairs are the second class. So we also have the exotic pairs. So the exotic pairs are maybe just sit at the class or whatever. Then we have the energy. So these are when I'm trying to show you the various tradable asset class in the market. So on the energies, we are going to have the crude oil, the Brent. We also have bond CFD. We have the crypto. We have the metal. Under metal, are going to have gold, silver, commodity. Are going to see things like cotton, wheat, cocoa, corn, sugar, Brent. So some of these things are the various tradable asset classes. You get. But when we are now looking at the major pairs, we are trying to bring our attention to the currency markets and focusing it on the major traded ones. So that is that about the major trading pairs. So you might, as a beginner, it's advisable as a beginner to focus on the major pairs. Since this guy, they are most traded, they're highly liquid, so it's going to be more easier for you to understand the price movements. Yes, so for that is that about that. Then let's look at the forex quote. So like I was explaining earlier, it's just the quotation of the base currency to the quote currency, or what we call the counter or payable currency. So if we say that the price of GBP/USD is 1.2850, so what this simply means that for you to get 1 GBP, you need to bring this amount of the United States dollar. This amount of the United States dollar. So that means for you to be able to get the base, we are going to use the quote to make the payment. So that is why the quote is called a counter or payable currency. So we are going to use the quote to make payments. So that means 1 GBP is equals to $1.28578. So let's say that we have a pair like USD NGN. All right, so let me just say, I think this guy he should be trading around 1.6 or so at the moment. You get 1.6 or so. So that means what this simply means that for you to have 1 USD, you need to bring 1,600 of NGN. So that is just the forex code. That's just what the forex code try to help you understand, so that maybe if you are reading some financial documentary, you are in the midst of trader, they are telling you that, okay, this asset is quoted against this asset as so and so price. You already know what they mean. Yes, so that's about that. So let me go back to my GPB. So I believe that is clear. But if it's still not clear, you can always drop in the comments or reach out to me. I will make it more clearer. Now let's come to pips, or what we call the percentage in profits. Now for those of us that did engineering, or people that did sciences, or people that at least we've done mathematics in your life, yet. So we measure, maybe they want you to measure length of a something. You measure it in cm, you measure it in dm, like centimeter, decimeter, or whatever, you get. And maybe for people into real estate like me, it's measured in acres and whatever, or square meters, you get. So, but when it comes to the currency market, we also have our own unit of measurements, you get. So price movements for the currency market is measured in pips. So this is particular to the currency markets and also in the indices market. So it's measured in pips. So pips simply means 1% of 1% of price, percentage in profit. Now, this is for the currency markets. Now, for the cryptocurrency market, we measure price movement in sats, that is Satoshi. So in reference to the guy that created Bitcoin, so we measure price movement in the currency market in Satoshi. So maybe in this thing on crypto, I'll be showing you how you calculate the SAT of any crypto assets you get. But for now, we are focusing on the currency market. Now, take for instance, given that the price of GBP is 1.2850, now 1% of price simply means 1/100, which is going to give you 0.01. Now, here we say that, sorry, let me see if I can write. So here we say that this guy is, we say that PIP is 1%. All right. We say that PIP is 1% of, that of simply means multiplication of 1% again of price. So that is what we say. So since this 1% of price giving us 0.01, now another 1% of 1% is going to give us 0.001. Now, so if GPP moved by 0.01, that is 1 pip. That is, say for instance, it moved from the price of 1.28570 to 1.28580. So when you do the subtraction, you are going to get 0.001. So that is 1 pip of price movement. That is 1 pip of price movement. Now, this is just to help you have an idea of how everything happens or work under the hood. You get, maybe if you are a quant trader like us that write codes and the rest, you can actually, this will not make more sense, so that maybe if you are trying to build your trading algorithms and you are trying to calculate your PIP, you know how to do it. Yes, but the whole of this, the bulk of this complex calculation and the whole this thing, it has been simplified by MT4. So when you are your MT4, your broker is, or your trading platform, your broker is already giving you the PIP. So you might not actually need to be doing the calculation manually, but just to help you understand what this means and how it's actually done under the hood or at the back end. You get, take for instance, if I just want to check the PIP of any asset, you get, or the PIP of price movement, I just come here, pick my crosshair, you get. So maybe just pin any point. So once you pick your crosshair, you drop it, pin any point, and you drag it down. So as you are dragging it down, so when you look at my cursor now, it's displaying 3 things. Now, the first is showing the number of candles from where I have my entry, or from where I pin the crosshair. So we have 6 candles. So the first is the number of candles. Now, the second is the PIP, that is 518. But now it's giving it in points, right? It's giving it in points. So for you to get the value in PIP, you divide by 10. So 10 points is equals to 1 PIP. So that means this is 51 PIP. So just throw away the 8. So the easiest way, the best way I do it is, okay, this is 518. Remove the last one. So you have 51 PIP. So from there to here is 51 PIP. Then the last thing that is showing you is the price level at this particular point, which is 1.27379. So if you want to measure the PIP or any pair or on the price swing, just click the crosshair, pin it to where you want to start measuring from, and drag it to where you want to stop. Like for here is like, this is 58 pips and these 4 candles. So if you check the candles, it's 4 candles, then at a price of 1.7007. All right, so for the PIP, it's going to give you in points. You divide by 10 and get your PIP. The same thing happens. This is 13 pips. That is 135 points, because 10 points is equal to 1 PIP. 10 points is equals to 1 pip. 10 points is equals to 1 pip. That is clear. Right? So that is that about pips, percentage in profits. Now, this is another important section you need to pay attention to. Position and loss sizing. So we still do this position and loss sizing more when we come to the risk management. I will still do it more when we come to the risk management section, you get, but I just want to quickly introduce it. You get, so that when you are seeing it, you know what they mean. I've used it when I place a trade, but let me explain it, then go back and show you again. Now, loss size is the buying or the selling power of a trader on an asset. So I say is a function of a trader's account size. Loss size is like your capacity, your power. You get, take for instance, if I have $1,000, and you have $10,000, and both of us want to go and buy cement, you get, you agree with me that the number or the bags of cement I'm going to buy at $1,000 will be less than the number of bags you'll be buying at with your $10,000. Maybe with your $10,000, you can just be buying 10 bags of cement, but with my $1,000, I'll just be buying 1 bag. And also, if you should sell your own cement, since you have 10 bags, you'll be making more profits. And me, if I should sell my own cement, since I have 1 bag, the profit might not even be meaningful yet. So that is loss sizing for you. Is the buying or the selling power of a trader on an asset. Is a function of your account size. So it's now your account size that determines how powerful you are in the market. So it's now your account size, how much you have in your account, that determines how powerful you are, whether you are a whale or you are not in the class. Now we have 3 major types of loss size. We have the micro loss size. The micro loss size, it represents 1,000 units of an asset. It has a volume of 0.01 and it has a profit of $0.1 per pip. So that means if you are using micro loss size, at each pip movement, you are making a profit of $0.1 when the market is going in your favor, or you are losing $0.1 when the market is going against you. That is micro loss size. We have the mini loss size. So the mini loss size, it allows you to get 10,000 units of an asset. It has a volume of 0.1 and it has a profit of $1 per pip. So if the market is going in your favor, you are going to be getting $1 at each pip movement. Then if the market is going against you, you are going to be losing $1 at each pip movement. Then we have the standard loss size. It represents 100,000 units of an asset, right? So it has a volume of 1 and it has $10 per pip. So if the trade goes in your favor, you are going to be making $10 per each pip movement. And the trade goes against you, you are going to be losing $10 per pip movement. Now, this is where the confusion comes for most new traders. When they now look at this profit per pip, they are saying, okay, since if I'm on 1 lot, I'll be making $10 per pip. You see that someone with $100 we start trading 1 lot. So this is like you over leveraging, and this is like you over leveraging. You get, we still do more of leverage, especially in risk management session, but I will introduce leverage here. But you should always know that the lot size you are going to use it's going to be a function of your account size. So that's why I say it's a function of trader's account size. So these are the various lot size now, but the one you have to use now is now based on your power. Now for the micro lot size, it ranges from 0.01 to 0.09. Then for the mini lot size, sorry. So for the mini lot size, it ranges from 0.01 to, it ranges from 0.1 to 0.9. Then from the standard lots, anything from 1 to infinity, if you like, be trading 100 lots, you are still under standard lots. So now the lot size or the volume to use is now a function of your account size. And also, these are the profits you make per pip. That is when the market is going in your favor. And also the profit you lose per pip when the market is going against you. All right, let me quickly show you this guy on the MetaTrader before we continue. So, like I said, stay with me. I will still show you how to use, I will still introduce you to this MetaTrader and how you can use it very well. Both MetaTrader and TradingView, I will show you how to use this guy. You use them to do your analysis and also to place your trades. So I will show you both for the PC and also for the phone. So stay with me. So let's say I want to place new order. Okay, so this column that has volume, so this is where you put your lot size. So if I want to trade one standard lot, so I'll just put it at 1. But if I want to trade maybe mini lot or whatever, I'll change it to whatever you get. So that's just it. I believe that is clear. Now let's look at leverage. I've mentioned leverage, but let's look at leverage. Now remember, when I was trying to introduce the lesson, I said that when I was talking about the brokers, I said that initially you don't have the power, you don't have what it takes to trade the markets. You get your money, your $100, if your $100,000 can't trade the markets initially, but through brokers, we're able to come in. So what broker does is that they gave us leverage. So that means any position you want to buy, the broker will give you 99%, you bring 1%. That is funny, right? So this is the only place that somebody will give you 99% and you just bring 1% to trade. But you should be careful because leverage is like a two-edged sword. So when you know how to fight with the sword, you fight to win. But when you don't know how to fight with the sword, you even kill yourself before you enter the battleground. Yes, so you need to be careful with leverage. So I'll deal with this more when we come to the risk management session. Yes, but I want you to just understand leverage, then we'll move on. So leverage is the money that the broker borrow or lend to traders so as to increase their purchasing power and control large trade with small amount of capital. So the broker themselves already know that you are broke, you have small capital, so they will give you leverage so that you increase your purchasing power. So that means with your $100, you can be controlling the same, you can be buying the same quantity of assets that somebody that has $100,000 is buying. You get. So it's quoted as a ratio of your account size. So when you want to place a trade, right? The broker brings 99% while you bring 1% of the money. So the broker indirectly, that is at the back end, is bringing 99% while you are bringing 1%. So that is when you are using leverage. So the 99% that the broker brings is what we call leverage. So that is leverage. When somebody say, I'm giving you a leverage, so it's more like you standing on his or her shoulder to, right? So the 99% broker bring is the leverage. Why the 1% you bring is what we call margin. We still explain margin next. Get. So what you just bring is 1%. Broker bring 99%. That is interesting. So leverage is not refundable. However, if the trade goes in your favor, you will get more profit. And if the trade goes against you, will lose more depending on your level of risk management. So risk management is very, very important. So it's like the hallmark of trading. So we still come to risk management. This is just an introduction. So when opening your Forex account with any broker, you choose from the list of leverage you want to use. So I will still show you how to open an account with brokers and the rest, and the brokers I use to get. So, and how you change your leverage. And above all, for now, don't over leverage till when we now do risk management, you now be able to know how to do from calculation, you know how the leverage to use based on your account size. All right. So margin, what is margin? All right. So stay with me. I want you to get this concept. All right. I will still show you this guy from both the MT4 on laptop and the MT4 on phone. How they are. So margin is an amount of money required to keep trade open. So it is not a transaction cost. It's just an amount set aside as a good faith deposit. So when you want to open a trade, since your broker is giving you margin, he wants to make sure that you did not lose all your money. You want to make sure that you did not cry and go home. So therefore, you must keep something outside. So there is something you will keep outside to keep the trade open and running. Now, maybe if you are running a loss, as long as it did not reach the margin amount, your trade will keep running. But once you lose it below your margin, or once your loss enters your margin, automatically they will close the trade for you and you are going to get a margin call. Yeah, like for guys that trade crypto, you might be hearing people say that I got liquidated. So you only got liquidated when your loss enters your margin. So as a trader, once you know what you are doing, you can never get liquidated, especially when you are trading futures. Okay, so it's only when your margin becomes small or when your losses enter your margin that you get liquidated and you start getting email, they tell you, sorry, unfortunately, you have a margin call so and so. But I pray that won't happen to you if you actually pay attention to risk management. So margin is the 1% you put in a transaction. So the 1% you put in a transaction is the margin, while broker breaks 99%, which is the leverage. So margin is the base unit of an asset per leverage. So that is just the unit. So for you to calculate the margin, you check the base unit of an asset, that is base unit of an asset divided by leverage, you get the margin. All right, so let's do some margin calculation. All right, so let's do some margin calculation. Now, given that, or for example, if a trader has $1,000 in his Forex account, and the account is operating on a leverage of 1:2,000, and he wants to trade GBP/USD with a contract size of 1 lot. I remember 1 lot represents 100,000 units of an asset. So this trader has $100, but he wants to trade 1 lot. All right. Then the required margin is unit of asset over leverage. So from what we have here now, the unit of asset is 1 lot, which is $10,000, and the leverage is 2,000. All right. So since margin is unit of an asset, which is 10,000 over leverage, which is 2,000. So when you do the calculation, you are going to see that the margin is $50. So what this simply means that since this trader has $100 in his account, as long as his balance, as long as his margin is $50, any trade he's trading with 1 lot will always be on. So this trader will need to have a minimum of $50 in his account to be able to trade 1 lot of GBP/USD. Now, instead of having to provide the full $1,000, so this is now the power of leverage. Okay, so with just $50,000, or sorry, with just $50, you'll be able to trade the same asset as somebody that has $100,000 you trade. Yes. So now, since this person is using one lot, remember, each peak movement in one lot is $10. So that means if price move by, okay, let me go to the MetaTrader. So each peak movement in one lot is $5. So that means if the price you move by, remember, he just have $50, he just have $100, and using a lot size of 1. So that means with a lot size of 1 and at a leverage just 1:2000, his margin is $50. So that means he need to set aside $50 to be able to trade this. So the minimum he need to have. So if the market goes in his favor by, let's say, by 5 pips, you get, so this is 5 pips. He has already made $50 extra. But imagine if the market goes against him by just 5 pips, he has already lose his $50. So he has blown his account. He blew that account. So you see why it's important to understand position, loss sizing, and leverage. So this is very, very paramount. So we actually go in depth in this guy when we be treating the risk management section, you get. So I don't want to dwell much on it. This is just an intro. All right, so I believe you got more understanding of margin, but if it's not clear, you still let me know. All right, so we also have what we call the equity. All right, so equity is the amount of money that you currently have in your accounts when the trade is currently running, either in profit or in loss. So for you to get your equity, you need to equate your initial account balance plus the profits. That is when the trade is going in your favor. You have the equity, or you do your initial account balance minus your losses. Then you get the equity. So when you open your trade, your equity is your account balance. So when you have a trade running, so if you now want to know how much you have, is now your equity that will tell you, because you are going to have an initial balance before you open your account. So before you open a trade, so as long as you have a trade open, your money is no longer the initial balance. Your money is the equity. The equity is now your money. Yes, so equity is you can still calculate equity by taking free margin and adding it to margin. So that is free margin plus margin will actually give you equity. So some of these calculation will come in handy. Maybe if you are someone that writes codes and you want to build your own trading system, yes. But under the hood, your broker is already doing the whole calculation and everything for you. Yeah, but you actually need to know what happens at the back door. Then we have the free margin, right? So the free margin is the amount of margin you have left to place new trade. So free margin is the amount of margin you have left to place new trades. Free margin is the amount of margin you have left to place new trades. So for you to get your free margin, you subtract your margin from your equity. Remember, when you have position or when you have trades running, your equity is actually what you have. Your equity is actually your own money. You get. So when you now subtract the margin from the equity, remember the margin is the amount you set aside, the minimum amount you set aside to keep the trade running. So when you now subtract the margin from equity, then you now have the free margin. That is the amount of margin left for you to place new trade. Yeah, we have the margin level. So for the margin level is your equity over margin times 100. So your equity over margin times 100, you'll be able to get your margin level. All right. So let me quickly go to the MetaTrader and show you how this works. So I'll still be using the MT5 for the indices market, because currently the market is closed, so I can't actually execute trade to show you this. So I will do it on the MT5, but it's just the same way it works. So the same way is in the MT5, the same way it will be on the MT4, whether you on your phone or your PC. But for now, we're showing you on PC. Then later on, I will show you with phone when I'll be treating the MT4. When I'll be treating how to set up your MT4 on both your phone and your PC. All right, so let's get started. So for this, I'll be doing this on a demo account. So because I just want to place an arbitrary trade and show you this guys. So I'll be running this on a demo account. Okay, two balls. All right, so for now, if you got this account, this is the balance. The balance is, so if you check, if you look now, you see that the balance is 969.88. And the balance is also equal to equity. And also the equity is also equal to the free margin. Both the balance, the equity, and the free margin, everything are equal because I don't have a position running. So I want to open up a position. I want to place a trade, you get. So when we place a trade, let's see what happens. So, and for this particular setup, I'll be placing it with market order so that I just show us what is happening, okay? So I'm looking at, okay. Okay, let me go with, VS V50 index, you get. So I want to place new order. So I just want to place this an arbitrary order. So an arbitrary trade. So don't try this at home. You get, don't try this at home. So before you place a trade, you need to make sure you have analysis. You need to make sure you have things supporting your trade. So I just want to use standard lot. That is one lot, or let me use two lots. Let me use two lots. Sorry. It's not allowing me to use two. Why? All right, let me use one. Let me use one. So, and I want to enter by market order. So let me just set my, let me set my take profit. So my take profit, I want to use, so I'm just using arbitrary value for now because I want to show you something. So I want to take profit as, I want to take loss at 168815.87. So remember, before you place a trade, always put your stop loss. So I did not do analysis on this. I'm just trying to place arbitrary to show you all these things I've explained about margin, leverage, equity, and the whole of them and the calculation. So for profits, I will go for 19,036.55. All right, so I want to buy. Get, so now I want you to watch what happened. You see that our balance, this is our balance, right? Now this is our equity. So we are having this equity because see the profit. This is $109. So that's why you see that equity is increasing, but the balance still remains the initial amount. So as long as you are in profit, this equity will always be greater than balance. But once we start losing, we are going to see that maybe depending on maybe you get, so it might be less alive. If you do 996, right, for the profit, we are going to get the, okay, so let me bring calculator. So I think we're using calculator. All right, so let's okay. So I believe my calculator is not blocking it. So now our equity, remember we said that the equity is your initial balance plus your profit, or your initial balance minus your loss. So So the initial balance is 9969.88, right? Plus the profit at the moment is 386.84, right? So when you do it, you are going to see that we're having 10,356, which is more like what we have here. So why the destiny is varying? Because price is moving and is varying. So now, but this is basically how we're able to prove that equity is actually your initial balance plus your profit when it's going in your favor, or your initial balance minus your loss when it's going against you. Now, margin. Now, if you look for this guy now, the margin is 60. All right, so the margin is 60. So that means in this $9,000 account, as long as I have $60, I can be able to trade one lot on this. So that is what this simply means. Now let's look at free margin. All right, so free margin, we say that free margin is the amount of margin you have left. Okay, let me go back to the formula so that we still follow. So free margin is your equity minus margin. So let's see if that is what is giving us. All right, so free margin is your equity minus margin. So you see that we are in a loss now. You see that the equity has dropped. So free margin is, let me clear. So free margin is your equity, which is 9. Let's see, it just 48. Okay, 9981. All right, let's just just moving fast. Price is just volatile. So 9910.05 minus equity. Sorry, minus margin. So margin is what? So our margin is 60.81. So when you do the calculation, you are going to have your free margin. So this is the free margin, which is 9849, which is more of what we have. But you see that it's still 9 something, but because of price is fluctuating, so we are not able to capture it. But this is just to show you the formula. Then for the margin level, once you do the equity over margin by 100%, you can be able to get a margin level. Yes. So, but you see that some of these things you don't actually need to calculate it on your own. So your broker is already doing the whole calculation for you, right? So they're doing the whole calculation for you. So now our margin is 60. So let me try and place another trade. Maybe let me place a sell trade. Let's see what happens. So I just want to, since I'm placing a sell trade, I'll use 196 591.72 to get. So I'm trying to use this as my stop loss, while I will be using a price below as my take profit. You get, this just arbitrarily dicing, like I told you. I did not do analysis on this, so don't try this. Before you trade, make sure you do analysis and know where the market is going. So I want to sell one lot. So let's see what happens, whether if the margin will change. So you see that margin is we are still having the same margin as it is. Maybe by the time you add more position, the margin will not increase. So once your margin increase, then that means for you to actually execute that trade, you need to have enough margin. You get. So as long as, let me just place another trade. You get. So arbitrary trade. So you see that the margin has, will I say, has increased from 60 to 121. So let me see, place another trade. So you see that the margin has also increased. So at every point in time we are placing a trade, you always need the margin to keep the trade running. So I'll close this guy. Close this guy. All right. So that is that about that. Then in the next video, I'm going to show you the brokers platform, or what we call the MetaTrader 4, how you set it up and the interface. So this is MetaTrader 5, use it for indices. So I will show you for MetaTrader 4 and MetaTrader 4, but everything is just the same. Once you understand MetaTrader 4, definitely you know how to use MetaTrader 5. Yes, so that is what I'll be showing you in the what I'll be showing you in the next video. Then, and also some of the brokers I used. So I want to close these guys. I'm just waiting for this guy to turn green, to turn blue. I'll close it. I did not do analysis on this guy. All right, so let me just close these guys. All right, so that on this section. So see you on the MT4 session. MT4 should be part 3. So I'll do both MT4 and also TradingView. You get.